The past few years have seen one global phenomenon after the next, starting with the COVID-19 pandemic in 2020 to the invasion of Ukraine by Russia and other global events. These phenomena, occurring one after the other, have put the global economy in a pretty rough spot, and most economies around the world have seen a downturn over the past couple of years. Economists even predict a stock market crash and a recession sometime next year. Obviously, a stock market crash sounds like a crazy deal and something to be scared of. But one thing to be kept in mind is that they are part of the market cycle. Markets go through periods of peaks and troughs, and a stock market crash occurs when the trough occurs. And it is also possible to be prepared to minimize your losses during a stock market crash. Stick around to the end of the video, and it is guaranteed that you will know how to prepare yourself for the potential stock market crash. There are many methods and strategies to protect your investments, as well as tips and tricks to keep your finances in check in the event of a stock market crash. But before we get into those details, first we need to understand what causes a stock market crash. Now, it is extremely difficult to pinpoint a single cause for a stock market crash, as there are a whole variety of causes for a stock market crash, which are, as expected, complex in nature. But although we cannot pinpoint, we can always look at factors that contribute to the larger cause. And by understanding these factors, investors will be able to find their way out of the volatility of the market. One of the major causes of a stock market crash is actually the situation of panic and fear among the investors. As an investor starts to worry about the condition of the economy or details of a specific company, they start to panic and rush to get rid of their shares, which causes a rapid and rampant decline in the stock prices. Adding to this, economic factors like a recession, inflation, or even high interest rates also contribute to market crashes. Apart from this, political instability or geopolitical events, as seen in the case of the conflict between Russia and Ukraine, can have significant impact on the stock markets across the globe. A market crash can also be caused by excessive speculation or speculative bubbles in some particular sector that causes the stock prices of that particular sector to increase uncontrollably, eventually leading to the burst of the bubble and the onset of a market crash. Understanding the potential causes of a market crash can help the investors prepare themselves and even diversify the impact that the crash would have on their portfolios or investments. Now, once potential causes of a stock market crash have been explored, it is necessary to look for the possible signs of a potential stock market crash. The most common sign of a potential downturn of the stock market is the volatility of the market. When the prices of certain stocks become increasingly volatile with large price swings in a small period of time, it indicates that the investors are feeling anxious about the direction in the market is heading. To prepare for this, it is suggested that you pay attention to news headlines and other market indicators, and focus on tracking the market volatility. An example of such an indicator could be the VIX index, which helps to indicate the overall sentiment of the investors. Another sign that investors could look out for this is a decrease in corporate earnings. When companies start earning lesser profits or revenue than what is predicted or expected, it could potentially lead to a sell-off of their stocks. Corporates are one of the major players in today's economy. So when the corporate earnings go down, it can be seen as an indicator of the national or global economy at large slowing down, which could eventually lead to a market downturn. Apart from these, other economic indicators like the rate of employment, the GDP growth rate, the interest rate, etc. can be seen as indicators of market downturns. If any of the indicators start showing signs of a negative trend, then it could be a sign of an impending market downturn. While market downturns can be hard to predict with accuracy, staying informed and watching out for signs of a downturn could actually help reduce the impact that a market crash would have on an investor. It would help them be better prepared and in a position to protect their investments even before the crash occurs. Protecting one's portfolio even before the stock market crash has occurred is of major significance, as it helps to safeguard their investments and simultaneously minimize future potential losses. While it is impossible to predict or pinpoint the exact time at which a market crash will occur, there are strategies that one could follow to mitigate the impact on their portfolios. The primemost step for that being diversification. As a proverb goes, don't put all your eggs in one basket. Diversifying your portfolio by spreading your investments across various asset classes and geographies could help reduce the exposure to a single investment or a market sector. What diversification does is that suppose one sector where you have invested faces a stock market downturn. If you have diversified your portfolio, It means that you have invested in other sectors of the market as well, and the gains from those sectors could be used to offset the losses from the downturn of a single sector. Another strategy that could be followed is to periodically rebalancing your portfolio. This means periodically reviewing your portfolio and ensuring that your investments are allocated in the manner of your desired risk profile. Rebalancing ensures that you are not overly exposed to any particular investment or asset class. This helps to protect your portfolio from critical market declines. It is also recommended that you develop an investment strategy of your own that is well defined. And it is equally important that you stick to your investment strategy even in times of market volatility and uncertainty. Development of an investment strategy means that you create your own personal investment goals, understanding your capability to tolerate risks and diversifying your investments according to that. Having a disciplined approach to investment makes it less likely that an investor makes a spontaneous decision owing to a market fluctuation. And the final step would be to stay informed and constantly review your investments. This would help to protect your investment from market fluctuations. It is necessary to stay updated about the latest market developments, economic conditions and indicators, and the performance of the corporate sector. By being better informed, an investor would be able to make more informed decisions and would take better protective measures for their portfolio. It is important to remember that protecting your investment before a crash occurs involves the investor to be checking out for indicators proactively, rather than waiting for the indicators to come to him. So far, we talked about how to spot an impending stock market crash and how to be prepared for it. Now we're going to delve a bit deeper into what exactly one is supposed to do in the event of a stock market crash. The obvious reaction to a stock market crash is to panic and make impulsive decisions, but the importance of staying calm and focusing on protecting your investments cannot be stressed enough. Now, what exactly do you do during a crash? Well, first things first, it is important to resist the temptation to sell off everything. It may seem like an option to reduce your losses, but selling during a market crash actually leads to significant losses. Instead, it would be better to shift your focus to quality investments that would be able to recover in the long term. The next thing that an investor should do is consider investing in defensive sectors in the event of a market crash. Defensive sectors are those sectors of the market whose elasticity is negative. That is, irrespective of whether the market is in a downturn or not, these sectors will still be in demand, like healthcare, utilities, consumer goods, etc. It is also recommended to keep an eye out for the market trends and indicators, and to stay well informed regarding the overall reaction of the investors. This information also helps you make better decisions for your own portfolio regarding when to buy or sell. The last step that an investor can take to protect themselves from potential market crashes is to use stop-loss orders. These orders automatically sell off certain stocks when they hit a predetermined price. Such a step helps to limit losses and protect one's portfolio. Once again, the importance of being calm and focusing on protecting your own portfolio cannot be stressed enough. But following these steps ought to guarantee that you minimize your losses in the case of a stock market crash. Well, that brings us to the end of the video. Don't forget to like, share, and subscribe for more content. Bye!